Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zach's Market Edge.
Welcome to Zach's Market Edge, the podcast about investing in your life. I'm your host, Tracey Ryniec, and this week I'm joined by Zach's chief equity strategist, John Blank. He's back with us to talk about the recession. We're not in one, not yet, but we're almost at the end of the first quarter here in 2023, and we're all still waiting. Will we get in one? When will it get here? What is happening out there in the economy with the stock market? How should you be investing right here with all this uncertainty? The Fed continues to raise rates on top of everything else going on. When will they stop? Will that matter? I don't know. There's all these questions out there. And John, I'm welcoming you back to discuss it all.
Thanks, Tracey.
So let's talk about our favorite topic, the recession. So I just put it out there that we're not in it, even though people on Twitter keep telling me, Tracey, we're in one. You just can't see it right now. But, some parts of the economy clearly are. Housing is in a recession. Manufacturing is in a recession, but the overall economy is not signaling a recession. And I keep waiting. I keep looking for the signs that we've talked about over the years of, that the economy is slowing, that we could be going into one. And I keep watching the employment. And so far, the employment is not signaling that we're even close to a recession.
Correct, Tracey. So let's begin by presenting everybody the facts, because this is what we tell people to do. So I think we should do it ourselves.
Okay.
So I've got the March 10th employment situation summary from the Bureau of Labor Statistics, ticker BLS.gov. It's the February non-farm payrolls. So total non-farm payroll employment rose by 311,000 in February, and the unemployment edged up to 3.6%. And I tell you also to go down to the revisions, which I will do. The change in total non-farm payroll employment for December was revised down 21,000 from 260 to 239, and the change for January was revised down from 13,000 from 517 to 504. With these revisions, gains in January and December were 34% lower than previously reported, albeit both well above 200,000. So we have a 500,000 number, a 300,000 number, and a 200,000 number in the bin for the last 3 months. Now, the other thing we tell people to do is you can access, we're talking March the 28th, which is a few weeks after this, and we've had a banking crisis, we can go to the unemployment claims.
Right.
And for the week ending March 18th, which is, right after the whole Silicon Valley Bank thing, the initial claims were 1,000, a decrease of 1,000. The 4-week moving average was 196,000, which is extremely low.
Yeah.
So we're still not finding any evidence so far of anything but a very strong economy. Now, that you did bring in the manufacturing PMI, so let's throw that out there.
Okay.
Manufacturing PMI in February the 2023 for the ISM, which is the best data, was indeed 47.7, which was actually 0.3 of a point higher than the 47.4 in January, and the figure has been contracting for 3 months. So, interestingly enough, there is a goods contraction. There is no evidence whatsoever of any change in the labor market, and that is the story of March the 28th.
That sounds pretty good.
It does, and that's what we need to keep people in mindful of is, at the end of the day, the reason this is true is the speed on which we ascended the rate hiking, starting basically in March or April of last year to now, still means we have 12 to 18-month lag before it has its true effects, right?
Right.
So what's happened here is people have conflated the speed of the rate hikes and the level of the rate hikes with the length of time they've been in place. And they simply have not been in place long enough. And this is why the Fed will go longer sideways than people think. And likely the recession, which certainly could happen, is more a 2024 event than a 2023 event. And it may even be a 2025 event.
Wow.
So
Most
that's the
people aren't
point that's
calling for
missing.
that.
Everybody's missing. The bond market's missing. Is lag effects for monetary policy are typically 12 to 18 months.
So you're not in the camp, it sounds like, where the Fed will pause soon, probably by the summer, and then they're suddenly cutting by the fall.
Well, I think the terminal rate at 5.1% is entirely accurate, which means they will hike one more level.
Okay.
Then what's going to happen is they're going to pause and move sideways and watch the data. Because 5.1 on the Fed funds rate when they end, if you take it down 1%, the core PCE they anticipate for the year that we're in is 4.1%. Right now, we had a 4.7% reading in January. So they're looking for, a half a point to a 3/4 point decline in the core PCE rate this year so that they can stay at 5.1%. And that's what they're going to watch out for. And they do bet on, people think, well, we're already in the decline. I want to point out to people, the Fed is betting on some of that decline already. The markets, what markets got wrong here is they will pause and they will not do anything until they get to a 4.1 core PCE, no matter what, when they're at 5.1. They're just going to wait it out. If they go to a 3.8, yes, they would cut, but that's what they'd have to see. People need to start realizing, listening to Jeff Goodlock and Bill Ackman and all these financial people talk about rates is irrelevant. They are chasing a statutory mandate. It is focused on the core PCE inflation rate, and that's what has to come down, period.
And what if it doesn't continue to fall?
Then they stay high, period.
Okay.
And now, the other thing to think about here in terms of the banking crisis really was about surprising people from zero rates who had a wash with liquidity with a sudden and oversized speed of rate hikes. What I would point out to people, there's two ways to look at that. One is this is entirely beneficial. We're starting wringing out the lunatics, the poor managers, and the numbnuts out of the system, and this is actually going to benefit the real economy, aka goods and services, right?
Right.
We're leaving a financialized economy, a grossly financialized economy, which was prefaced by 0% interest rates, for one that actually makes, real earnings for real goods and services. So you telling me we're getting out of crypto and it blew up? You telling me that some absurdly over-liquid Silicon Valley transaction base blew up? You telling me that, the only bank in New York that had any crypto, business blew up? I'm telling you, good. I mean, right. The other thing I would tell you, just for example, people, I need to understand this, and I don't even think you know this, Tracey, but I did work for CIT Group in Los Angeles for 8 years on the side, last 2011 to 2018-ish, before COVID, and they were bought by First Citizens. Okay. First Citizens did acquire Silicon Valley Bank. Right. And why do I support this? Because they had CIT, which is a big part of First Citizens in California. It's not the biggest, probably the only biggest. Had already bought One West, which is a retail bank in Pasadena, largest bank in the south part of the state that's not Wells Fargo, Bank of America. Now they have a base in the Silicon Valley area. They were the natural fit, and they don't increase. They increase competition in California because they get bigger and can face off against B of A and Wells Fargo here, so that they don't, load all the assets into, Citi and J.P. Morgan. They actually create, a 20 the size bank to a 15th size bank in the process. So in general, you have to applaud the FDIC and those. We have to wait again. Did it work from a financial perspective? That's going to be found out 5 years from now.
So you're not a big proponent of consolidation, like massive consolidation in the banks.
Well, that's the thing that they did smart here. The FDIC did not. They invited and probably assisted First Citizens, which is the 15th or 20th largest bank. But they're on the model. They get the Raleigh East Coast base and the big West Coast business, and they're national, and they grow them up as opposed to expanding one of the 10 or 12 big ones. So and the other thing that's really smart here is First Citizens, through the One West transaction and the CIT transaction, has lots of middle market small business lending ability, and they have lots of retail business, so they understand the pitfalls of those businesses out here. Because there's no question that California is getting the epicenter of the decline in housing prices and a lot of the loan problems this time around. I guarantee that.
Yeah, I think that, that's where the housing recession is starting to hit the hardest.
Yeah, we got a long ways to go, people. The other thing I would tell you is, anybody who thinks that we're just going to knock out 10 or 15% correction out here is absurd. I saw today the San Francisco office vacancy rate is 29%. 29%. That means a third of business offices are empty in San Francisco right now. And so they're not recognizing those losses, and because the leases continue to pay and people continue to negotiate. But somebody effectively has to price it right in the aftermath of it. And part of the FDIC's deal with First Citizen was, sharing haircuts on commercial lending for the next 5 years. And I think that language, sharing haircuts for 5 years, is exactly what I would have said too. You got a 5-year window here of sharing haircuts across the entire state. Now, I do not know a 39 million person state. The actual housing prices east of the Mississippi are going up right now, not down. And I simply do not think it will affect the great bulk of the population in those states. And frankly, Florida's at 2.5% unemployment rate, may not even reach Florida. So it really may be that this is a regional contraction, and then we just have the same game to play we started the show on, which is, does it really net out at the national level to a, quote, recession?
I don't know. That's the big question, because even the .com bust, which is kind of similar scenario to me, but that was mostly contained in the northern part of California, not even the south at that point. It hadn't, tech hadn't really come to LA yet. Now it has, obviously, but even that initial slowdown felt really contained to just the Bay Area. The Bay Area was definitely in recession in like 2000, 2001. And then the rest of the economy did finally go into recession in 2001, though, nationwide, but it was mild, compared with what was going on in the Bay Area. The Bay Area was not mild during that. Like, there were several 100,000 people left. Home prices declined. There were like entirely empty office buildings, the same kind of scenario we're seeing here. They overbuilt for all the .coms, and then nobody needed that space. And it took years to work itself out, as you're implying. It's gonna again, but now it's really gonna impact the entire state, and you have housing on top of it. You didn't have as big a housing, boom and then bust in 2000, like you are going to have this time. Yeah.
So this gets to the reason we do the Bureau of Labor Statistics, not the California Department of Economic Development, right?
Right.
I mean, people need to understand, when you're an economist, this is another thing to really understand. Why we go to these statistics, they're called summary statistics. They summarize all the influences that are happening out there. So I will not argue, have not argued, and do not argue, and you're not going to argue either, that there's not going to be a recession in California. Absolutely will be one. Right. Probably already underway.
Yeah.
But in the summary statistics for the United States, there's no evidence of that, because the tech workers leave California and they're the first people to get hired somewhere else.
Right.
The tech workers who take a haircut on $1 million house in California can afford a big one in St. Louis for $400,000. Yeah. And all these other economies can become vigorously stimulated by a breakdown of the California tech economy. And we're seeing that in, Facebook being a number one ranked stock right now. Yeah, last year when Zuckerberg was, pie in the sky with Meta, sure, fine. Now he's firing people. Salesforce, same thing. But now Benioff's firing people, and they're going to make cash. They're going to turn their businesses around, and they're going to position people outside the Bay Area. Or the people are just going to work remote and then stay out of it, right? I mean, so this is, typical behavior when there's structural change. Remote working is structural change, and it gets layered into a cyclical change, which the Fed is introducing, right? So these are two pieces of language. They're happening at the same time, and you and I trying to disentangle the structural change of remote working in offices from the cyclical change the Fed is imposing through the rate hiking. Good luck with that.
Right.
And the answer, Tracey, is always the same. And that's why we start these shows always the same, with the humility to just go to the most recent data and say, Look, we don't know. We got to do this shows all the time. We have to do this every quarter, and we have to stay on top of this. I'm not saying there will be no recession. I think Goldman's right. There's a third chance of recession in the next 12 months, 1/3, which is very high. And we should not and will not get this right without paying attention to the data and not being the biggest genius on earth. Plenty of geniuses out there, and that's fine, but they're going to say they're right when they get some forward call right, and they're not going to tell you when they're wrong. Like Bill Ackman's not going to tell you that he got the rate call wrong last week. Jeff Gutnick is not going to tell you that he got the rate call wrong last week, right?
Right.
Because they did. They got it dead wrong. And so
even the doom and gloom about
these people up there when they get calls wrong, right?
Yeah. And even the doom and gloom about the banks.
That's
Several of them immediately were like, we're doomed. It's, the end is near. And now they're kind of quiet again.
Yeah. And so, did we see $300 billion in liquidity drawn from the Fed? Yes. Did we see $120 billion in deposit shifting from small to large banks? Yes. Now let's do that against the size of the U.S. economy, which is $27 trillion. So if you're moving things around in 300 billion increments at best, you're doing something that is slightly more than 1% of the U.S. economy.
Right. And I don't understand the fears that all of the regional banks are suddenly in trouble, including like Wintrust Financial here in Chicago. Or I could name a dozen other ones that are not on the list of the ones that people are worried about, but are outside those that are huge regional banks as well. And it's just, they don't have the same issues. It's just, they're just not. They don't have the number of uninsured. They might not even have the same kind of deposit base that some of these other ones have, not even close actually, when I'm thinking about it. So I don't really understand the panic about all of the regional banks, and there's several hundred of them. Like there's a lot.
Yeah, well, the other language of a regional bank is they're somewhat disconnected from the national economy. They're regional, right?
Right.
So if you're a regional bank in the Southeast or a regional bank, Fifth Third with big business in Ohio and Chicago, neither of which have blown housing bubbles up.
Right.
And frankly, you say, hey, they're only going to welcome the movement of people out of California. This is the problem. You say, well, where is the transmission mechanism to blow the economy up? Again, we have to find out where the excesses are. They're in California. I guarantee that. But that's 10% of the U.S. economy, 12%, 15%. It's not. So if I take a 10% takedown of California on a 15% number of the economy, I'll be very generous. It's a 1.5% decline in GDP, 10% of 15%. So yes, I can get, my trend growth at 2.5 to 0.5, 1%. And Garrett, guess what, Tracy? Guess what the latest consensus economics GDP growth forecast for the United States in 2023 is?
About
1%.
the same. Yeah.
That is we should have done trend growth at 2.5, and then California blew up and took 1.5% off it.
Right. Couldn't we see
your 2002 scenario? The first place we got to go is just stagger around with that kind of thing for a while, right? And then we get to see a much more. The dumb people with the rate hiking are now out of the way. The real dumb thing is when the staggered commercial real estate thing plays out, which will take years. That gets to where the recession is, which is probably 2024 or 2025, right?
Right, because I don't see how that's a catalyst, like some kind of black swan event. Everybody's treating it like a black swan event that's going to happen by this summer, that all the commercial real estate is going to collapse. And then the banks that are holding those notes, they're going to collapse. And then it's all collapsing down like all at once. No. This gets
into the basic Nassim Taleb problem is he wrote a book, got a lot of credit for it, got one call right. Now it's been 15 years since he made a good call. We got too many people who don't do the simple, humble thing of going to the data and saying, is there a recession? The answer is not even questionable. There's absolutely no evidence whatsoever of recession right now. And then we just got to be diligent and humble and keep at it. So the problem people get here is you can be out of the market, safe haven, and then it turns out, the Fed gets the PC down to 3.1 in 12 months and they cut rates, and you're the dumbest guy on earth because the market's going to call that 12 months in advance.
Right. Always forward looking. Yeah.
The market's forward looking. So we know the 10 years at 3.5. There's some of that's Alvin is right, which is they're looking at a 2024 core PCE at 2.8 or 3. And the Fed going to then the market's going to price that in sometime in the late summer. And you're going to be the dumb guy watching the market go to 4,600. So why is the forward 12-month top down aggregate S&P 500 target at 4,600 for 12 months? Because of the read through, right?
Yeah.
So you get to be Nassim Taleb, and you get to be on, multiple shows looking for your 2% event, and it doesn't happen, and the rest of us get screwed in the market. Now, you don't want to be dumb. I mean, the thing I've learned as an economist, if you want to outsmart 90% of the economists, just go to the employment situation summary on everything you do a couple times a month, look at the non-farm payrolls, look at the unemployment claims like we do, and just say, hey, that is what's going on now, contemporaneous now.
So what would you do as an investor then? Do you, some of these like big tech already appears to be a safe haven possibly, but also maybe pricing in what the scenario you were just talking about already? Meta has doubled this year in 2023. We know NVIDIA has almost doubled. Microsoft is up big. Even Google's no longer cheap on a P or a price to sales basis. Would you be still going into those? They've already rallied. Or do you want to be in some of the big banks, the too big to fails? I took a look at some of those. They have, very low price to book, which the bank analysts have always said you buy at 1 on the price to book with the bank, you sell at 2. Well, I took a look. Wells Fargo price to book is 0.88. Citigroup is 0.47. Bank of America is 0.9. And JP Morgan is it's the most expensive, but it's still cheap at 1.4. So is that, with everybody panicking and, maybe you don't want to be in the regionals. I get that part because it's a little more iffy, but the too big to fail, they're all cheap. Do I want to hang out in those?
What's your answer, Tracey?
Yes, I feel like I do. Yeah.
They're
too big to fail. They're not going to go down. So, and they're cheap.
I put a bid out this morning on Visa, right?
Okay.
Because Visa, you say, okay, Square might have, some issues. Crypto's blowing up. I simply do not think the consumer is going to just disappear, certainly not globally. And I buy Visa on a pullback and just ride it up. Yeah, and I think the same with JP Morgan. I think, you say, okay, JP Morgan's $3.5 trillion in assets. They're 10% of the U.S. economy. They're broadly diversified across everything. And again, they're definitely reserving. They're definitely prepared for a downturn. There may even be a downturn, but they simply cannot disappear. And so, at the end of the day, you buy stocks when the VIX goes through the roof and everybody's panicking. The one problem with your analysis here is we still have a 20 VIX, not a 30 or 40 VIX. And
correct.
It could be the point that you could pick JP Morgan up on a 30, 40 VIX here in another 4 or 5 months, right? Getting people into stocks and then they blow up even bigger, and you should have stayed and just, got the trade idea right, but the timing wrong. It's entirely clear to me that we need to have an event, some credit event or some other event that punches us to a 35 VIX, and then I think the bottom's in.
Well, what do you think about the debt ceiling being that event?
Well,
it's starting to heat up again. There's some letters flying back and forth as we're recording this on March 28th. And we have it, the deadline is, I think, June still, but maybe it could be extended into July. But things are starting to happen with the debt ceiling. Yeah.
This is a inside the Beltway negotiating tactic. It never, one of the defects of my own career, if you will, is I have not spent time in the Beltway to really give like the Axios Politico angle on those events. But Axios Politico are places I would carry on reading in terms of understanding that. But do I personally think will McCarthy do this? The problem with saying he won't is we don't have an election next year. So McCarthy, so why does McCarthy care? And he thinks he can get the debt ceiling done. I personally think he will want to carry on to the very, very last minute, no matter what. So at least whoever's pushing him to do it feels like they're vindicated and he gave his best shot. Right?
Correct.
So I do think brinkmanship will be the norm. And then I think when he gets his side of whoever's pushing him satisfied that he did he did what, a good faith, quote, good faith effort on the whole debt ceiling from his perspective, he can just walk away from it and just say, fine, it didn't work. I don't care. I don't want to blow the economy up in 2024 before the election.
But that reminds me of the scenario from 2011 where the same brinkmanship happened about the debt ceiling, and they went until 3 days before, but the S&P 500 did fall 16% while the brinkmanship
you get a mix of 35, in mid-August when McCarthy gets dramatic and this whole thing, he pays out his people and all that stuff.
Okay. Yeah, that's what I think too. Yeah.
Yeah.
So
you're not saying it's going to happen. You're going to say there's going to be an event that's going to make things, appear to happen, right?
Yeah. But, investors might want to have some cash on the side. I know I'm going to try to have some in case this happens.
Yeah. I mean, that's the thing. The market, the shorts and the day traders and the VIX people will push us in over the edge and try to squeeze people during that time.
Any other areas you like? If people are waiting on the sidelines and, maybe they do have that cash and then they're going to try to get in if, the VIX rises, there's more of a panic and we finally do maybe see a bottom. Is it, would you be looking at some consumer type stocks like a Nike or somebody like that? Or, is energy in your sights? Warren Buffett is buying more Occidental again here in March 2023, or is there some other area you're looking at?
Well, one thing I did, on Zach's Professional Services, I did this work on the industrials.
Oh, okay.
And there's this Industrial Renaissance ETF by Richard Bernstein. And I'm going to find the ticker for you. And this is from a very statistical perspective, AAIR, ticker AAIR. RBA, American Industrial Renaissance Index. And this thing has the type of industrial companies, mid and small cap companies, not banks, that is really interesting. So I would tell people to take a look both at that ETF and at the constituent elements of that ETF.
Is it
AAIR?
IR. Okay.
Yeah. So if I go into our system, let me see if I get, AIRR. AIRR.
Okay.
And I pull up fact sheet. It says First Trust, RBA, American Industrial Renaissance. Got an expense rate of 0.7, which is not that bad. And it's got lots of really good stories. For example, the 5-year performance is 10.9%, which is slightly better than the S&P 500, or within the zone of respect over time. The S&P 500, might get you a little less than that. Again, you're only talking about a beta of 1.05. You're not getting a very little lift. The S&P 500 is a 0.9 beta. The Russell's a 1 beta. But this is the kind of trade where you can both look at the ETF and also the stuff in it. One thing I've learned about these industrial names is you just don't know them really well, and some of them are really kind of interesting businesses, and you get them at a certain point. You're like, okay, I get this business.
Yeah, agreed. And especially these are small and mid caps. So they're not going to be the Caterpillars of the world that you already know about.
Right.
These are the unknown ones that are kind of, been around like 40 or 50 years in some cases, but they fly under the radar, but they are good businesses. Yeah.
Right. And Richard Bernstein knows what he's doing. I've looked through the names and I've run my team has run the returns elements, total return elements, and he does outperform with this thing. Okay. Not dramatically, Tracey, but
Right. But yeah, there are a lot of people who like the ETF option because they don't want to figure out the small cap industrial. They don't want to have to go research it on their own. So why not buy a basket of them? That makes sense.
That's it. Yeah. And the other thing is, if you want to research him, we'll let Richard Bernstein do it for you and just pick him off, cherry pick him, right?
Right. For sure. Yeah. I always recommend that too, that people go in there and look to see what these ETFs own.
We're throwing that out there. Ticker AIRR, go into Zacks, log in and get the fact sheet and the portfolio lens. Then take the tickers, the top 10 tickers, and look at those.
Yeah.
And then once you get in there, you're going to find one that's going to have a good Zacks industry rank and a good Zacks rank itself. Nice set of surprises. You're going to look at the chart, go, yeah, I get this, not overvalued, and nobody knows about this little name. And then you pick 3 or 4 of those up.
Yeah, you could.
You don't pay Richard Bernstein a penny.
That's right. That's right. You don't.
You don't.
Yeah.
So, I just point this out. What I like to do, a kind of top-down element is to, look, I like industrials, but I like this arrangement to play industrials, and then I drill into it. And you can find, look, there's 6, 8, and 10 names that are going to pick this index up, that you can make some calls using the Zacks ranking systems to identify those.
Okay. That's a good strategy. Yeah. I'm liking it. We need a strategy here in 2023. A lot of people are just kind of treading water right now, unsure what to do. That's why they're all pouring into the big cap, tickers, because they're scared and they're not sure where they should be even looking right now. So this is a good idea.
Yeah, that's why I put it out there. I think, you just let a lot of things work for you, and then you try to learn, and again, try to learn from existing groups of information bases like our own, and say, hey, this is better than me like having big pie in the sky discussions over coffee.
Right. Yeah.
I get a little too much of that out of retirees. I think, no, that's just not going to work for you. You're only going to rehash what you heard or read.
Right. Yeah. Okay. Well, this has been a good discussion here in 2023. As we've been saying, we will have another one, and maybe it'll be around the time when they're discussing the debt ceiling. You might have to have you back on when all that is going on, John. But we'll see. We'll see what happens over the next couple of months here in the U.S. economy. And as John said, we're taking it month by month with looking at that data and then evaluating everything. So let me recap a couple of the stocks we did talk about on this episode. So John mentioned Visa. He's buying in there, ticker V for Visa. JP Morgan is one of the big banks we mentioned. JPM, Bank of America, is BAC. We mentioned Citigroup, that's ticker just C. Wells Fargo, ticker WFC, I mentioned them. And then John did mention the Industrial Renaissance ETF. That's a new one. We've never had it on the podcast before. Ticker AIRR. A is in Adam, I is in I, is in I, R is in Robert, R is in Robert. So 2 R's at the end there. It holds 49 small and mid-cap industrial stocks. So check out that ETF. Use the Zacks rank. Check out the holdings on that ETF, as John was mentioning too. You can at least get the top 10 holdings there right on the fact sheet on Zacks.com when you plug in the ticker. But be sure to do your research on all the stocks we talked about. And as always, I will be back next week with some more stocks, but you need to get us. So make sure you get us on Apple Podcasts. We're on Spotify. We're on Amazon Music. We're on SoundCloud. But get the podcast somewhere, and I'll see you again next week.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.